So the inclusion rate, as I said, is 50%, which means you're taking half of the capital gain into your income, but then you're applying your tax rate to it. So generally for the purposes of this class, you're operating at a high, you're calculating at the highest personal tax rate. So it comes out to be federally plus provincially to be about 50.4%. For CCPCs, it's calculated, I believe, similar to SIB and other types of calculations where you have your refundable tax there. For a CCPC, the non-taxable portion is added to what's called your capital dividend account. I'm not sure if that's somewhere where you've reached yet, but I'll talk about it now just because it's sort of on the way to our next topic anyway. Capital dividend account is basically the way the government lets you distribute tax-free distributions through dividends to a shareholder. That's how they deal with the inclusion rate. Instead of making it so instead of doing it one way, they let you actually take out the portion that is not taxable as a tax-free dividend from your corporation.
Why?
So, pardon me?
Why?
Why do they let you do that? So the reason why I believe that they would do that is because when you would earn a taxable or a capital gain outside of a corporation, you have it in your pocket already. Whereas if you've earned it inside a corporation, it wouldn't really work out to be even close to the same if you also had to pay dividend tax rates on that non-taxable portion. Yes.
Is it the Simpleton case where it took money out of the firm to buy a house and then took a loan? Is that the sort of account that he would have originally taken the money out of?
I don't think so. So there's two ways. The two most common ways I would say of extracting money from a corporation tax-free are through a loan, and by loan I mean your balance to your shareholder loan account. Yes.
Honestly, I just wouldn't go through it this time.
Don't go through it.
Short answer: this has nothing to do with this single use.
Oh, okay.
Okay. So again, so the capital dividend account is there to sort of allow you to withdraw the non-taxable portion tax-free.
Because like you said, if I have a capital gain as an individual, half taxable, I never pay tax on it. If I instead earn that through a corporation, I still want to be able to make sure I have taxable only. Let the corporation pay tax on half of it, but gosh darn it, the other half of the capital gain, the non-taxable half to the corporation, I want to be able to take that out tax-free, because it would have been tax-free to me if I earned it as an individual.
Okay, so next we're going to go on to dividends. Does anyone have questions about the capital gain, deferred proceeds, or capital dividend account, or how that works? And if you have one randomly while I'm talking about dividends, that's fine. Okay, so what are dividends? I think you've learned a little bit about dividends so far. I think you learned the difference between an eligible dividend and an ineligible dividend. Essentially, a dividend is one of the ways, and I would say it's the most distinctive way a corporation would pay profits or pay out their profits to a shareholder. Legally speaking, there are things you need to actually do to declare a dividend. So technically speaking, and generally speaking, unless there's a unanimous shareholders agreement that changes it, but generally speaking, a dividend is declared by a director. And so while shareholders control the company, directors are the ones that usually are declaring the dividends and saying, this person gets this dividend, this person, this class of shares gets this dividend, this class gets that dividend. So there should not be an apostrophe in that act. Sorry, that's my typo. The there are reasons why you can't declare dividends. So if you're a director, you actually have to say, declaring this dividend wouldn't make the company insolvent, so therefore I can pay out this dividend. And you know, lots of tax planning involves avoiding paying taxable dividends, and the same thing applies to designation of an eligible dividend, which is a more efficient dividend, as you've learned, and capital dividend, which is the most efficient of dividends. And sometimes there are circumstances where you can't declare a dividend, you know, through, you know, share privileges, Corporations Act, etc. And you know, that sort of hampers your tax planning. So that's why it's important when people come to you to get their business incorporated, for example, that you have proper share classes set up, that you're not restricted in making these dividends, that they're discretionary, you know, if that's what they want, and you know, they have to follow the legislation under the Corporations Act. So that's sort of just an aside to sort of the main meat of this, which is the taxation of those dividends. So assuming you've done all of the legal requirements, and you know, CRA, and on one hand it is a tax issue that the directors have to declare it, because sometimes CRA says this dividend wasn't properly declared, or you had no there was no position to declare this dividend, and they come back and reassess your client, and you have to sort of prove that there was, you know, a properly declared dividend. For the taxation of dividends, there are multiple ways that they're taxed depending on who the dividend recipient is. As I'm sure you're aware, corporations can be shareholders of other corporations. So the first one I'm going to talk about is a dividend paid out to a connected corporation. A connected corporation is basically one that holds more than 10% of the votes. So we sometimes have a 10.01 shareholding for that purpose. Yes?
Can we pull out the act at section 112?
112? Yes.
Bracket 1, please. So, for those that have the paper act open, you'll notice at the top of the page that we're in part 1 of the Income Tax Act, and part 1 is the part of the act that we've been living in so far. So taxes payable, small business deduction is allowed, et cetera, et cetera. So part 1 is probably 2/3 of the Income Tax Act, and it has most of the calculation of tax. Tax on individuals, tax on corporations. For the purpose of Part 1 tax, in which we are in section 112, we get to deduct dividends received by a corporation. So a corporation receives a dividend from another corporation, totally deductible, no Part 1 tax. So then the Income Tax Act says, well, are we going to tax it someplace? Now please turn to section 186. In the Act, which is top of the page, Part 4 tax. Every corporation will pay a tax of 38 1/3%. By the way, just for, it is no coincidence that this 38 1/3% is a percentage that we saw earlier in the calculation of civic and the refund that gets paid out when dividends are paid out. So no Part 1 tax, but Part 4 tax of 38 1/3% of dividends received. Thank you.
Okay, so, right, so if you know you have a wholly owned subsidiary and the subsidiary is your operating company that's making money and you're setting it up to your holding company, generally speaking, that is a tax-free dividend. Generally speaking, I'm not going to get into instances where it's not because that's sort of beyond the scope here. But so you know that's sort of a general rule to be thinking about when you're doing tax planning is that intercorporate dividends between connected corporations are generally tax-free.
Can you throw up a picture, Leo, on the whiteboard? So what does that look like? Individual, corporation, one, corporation, two?
Is there a okay, so if you have a okay, so here's an example of where it's wholly owned, so I'll just throw 100% here. And this is also true if it was 10.1%. If a wholly owned corporation can send a dividend, and this dividend right here will effectively be tax-free because of Section 112 sub 1. And you're looking at Section 186 to figure out if this is going to apply. You know, there's lots of circumstances where this can't be paid as tax-free intercorporate dividend, but this is sort of what it looks like. You know, you have the full ownership. This is where the money is being generated. So to send this money up through a dividend, the Income Tax Act lets you deduct the amount you would have received. So it's effectively a wash on your corporate tax. When this corporation pays out a dividend to the shareholder, who's an individual or a trust, for example, that dividend you have to pay your dividend tax rate on, and you know the GRIP account would flow with that as well. Are there any questions on that? Yes.
So essentially, dividends can flow through connected corporations, and they won't pay tax on that effectively until they're paid out to a non-connected corporation or an individual.
Generally, yes.
No Part 1 tax.
Part 1 tax.
Leo, before you, I like that slide, third bullet point. So
Oh, yeah,
in your
sorry,
example, on your picture, under what circumstances might there be Part 4 tax paid?
So Part 4 tax would apply. Sorry, Part 4 tax would apply based on the ownership percentage. So if there's been no SIB or taxable capital gain, there isn't a Part 4 tax. But the way that once there is Part 4 tax available, it will be applied on the dividend to, yes.
So what if the OpCo had earned SIB income?
Okay, so the OpCo,
Earned interest income, let's say.
So on this dividend, there would be, I believe, a refund. So I'm just sort of getting into it. So there would be a refund paid on that dividend. But if there is a refund paid, there would be an application of Part 4 tax in proportion to the ownership percentage.
Perfect, so let's take that a step at a time. So the OpCo, the bottom company, gets a dividend refund because it earned SIB income and paid that wacky tax that adds up to 50-point-something%. So it's paying a dividend to Holdco, and it qualifies for dividend refund. And in the textbook, there's actually a nice diagram that shows that we end up with a pretty large, actually, refund back to the operating company. So the operating company says, awesome, I have maxed out on all the refunds that I'm entitled to. Now what happens at the Holdco level?
Sorry. So when the OpCo gets the dividend refund, then there's Part 4 tax applied equal to the ownership percentage of the dividend refund received. So, for example, in this case, it would be 100%. So
let's say that the OpCo got a dividend refund of $12,000.
OpCo
Got a dividend refund of
dividend
$12,000.
refund of $12,000.
Can you write that down under OpCo, $12,000 dividend refund? So this is a question for the class now. How much Part 4 tax does Holdco have to pay, given that Holdco got a dividend and owns 100% of the shares of OpCo?
Yeah.
Beauty.
And then when Holdco issues a dividend to its shareholders, it would qualify for the same $12,000 refund, right?
Correct, assuming that it pays a large enough dividend
No,
to.
the entirety of that forward dividend.
Absolutely.
Very great. And this was like the hardest part of the class on exams. So, yeah. So it's important to keep track of, and I don't know if do I go into that? Oh no. For refundable dividend tax on hand, that's not something I'm going into now. It's just something that's going to pop up in this situation, you know, way down the line when you're doing this on the exam. It's to keep in mind that 38 1/3%, and just to sort of tie it up to the ways that you would be paying Part 4 tax is you have this, and for math purposes, I usually just do 38.33%, but that's not really what it is. It's 38 1/3%. So when there's it's sort of I said discouraged, but it's sort of just when there's a non-connected corporation. So let's say it only owns where's the eraser? Say this only owns 10%. You know, that's a bit mean. I'm going to say 9% just to make it obvious. So let's say this owns 9%. So you know, the reason why they're trying to discourage this is because they don't just want you to incorporate you know, and get a huge advantage when you're holding shares. They're sort of trying to, you know, as you learned about integration, I'm sure in the beginning of the classes, there's lots of interplay between trying to make it similar to if you're holding a business in a corporation or holding it personally. But that being said, so let's say that in this situation you have 9% ownership, and this dividend is no longer tax free. There is a Part 4 tax on this dividend equal to 38 1/3. So it's a refundable tax similar to the one that you've dealt with already in SIP, and it's there to sort of prevent the crazy deferral that there would be if you paid it up through a non-connected corporation. Now keep in mind the deferral is still there if you're paying it through a connected corporation, but this is to make sure it's not there for a not connected corporation. Anybody got questions on that stuff?
I'm gonna suggest we stop there.
Sure.
Why don't I hand back these and we can wrap it up.
Sounds great.
No, there is tax on it if they return to the city. Right, because then the tax that they pay the road tax, so that's 12,000 times the percentage. Right? Does that make sense?
We're gonna make some piles here. If your student number ends with 0, here. If your student number ends with 1, here. Come on up. Student number ends with 0, 1, 2, et cetera, et cetera.
I know my writing. I think I can figure it out from my writing.
Who did write your student number? Nice work. These are the actual marks, so that's the distribution. The correct answers are 1, B is in Bravo. Actually, it's BBBF. BBBF. The mechanism to avoid double taxation is small business deduction, et cetera, so lower rate than an individual would pay on the same income. Awesome. And then charging the individual higher rate tax on what kind of dividends? Non-eligible. Number 2, that whole thing about selling land, et cetera, is just fine. There is no evasion with respect to that. Correct answer is B. And it is actually going to save tax. If the higher income spouse were paying tax on the investment income that comes off of $500,000 of investments, now the lower income spouse will be paying tax on that investment income. Number 3, a corporation has $500,000 of active business income, also has exactly 12.5 of taxable capital. You may recall that diagram where we when taxable capital gets to be 10 million, we have a $500,000 capital gain, small business deduction between $10 and $15 million. It goes to 0 and 12,500,000 is the midpoint. Our small business deduction is based on $250,000, which is B. And for the answer is F, because if we're claiming the small business deduction on 350 and assuming that B has enough income to use the rest, which is 150, then B can claim the small business deduction on $150,000, F some other amount. Happy to answer any questions at the end if you have any concerns. Your marks have been posted to Learn already, so please check to make sure that I have posted correctly from your paper to your mark, please. I appreciate that. I do make the occasional mistake, hopefully not today. Thank you, and we'll see you next Tuesday.
So I just like I reread the language because I originally had circled this and I even like left a note there because I knew that it's like the total was the 500K, which is why I said should be 150. But the way I read the question was, which one they should, what's the maximum amount given that they've already claimed 350. And so I looked at these numbers and I was like, okay, like what amount could they claim? Because they could claim a max of 150 is left, and then right? But what's under 150 on those numbers? That's the only reason why I circled that based on the language. I figured based on your quiz ones that you posted before, you had ones with multiple answers, so I figured I would be covered either way. Which is why I circled that. It's not that I didn't understand it.
For me, whether it was 5 to 10,
So I don't know.
that saved my life on that one.
I think it's a combination of the fact that it's for fair market value and it only.
No,
I remember. Because I mean, I even wrote.
So like the way I interpreted the language was not what is the maximum amount that the corporation can claim.
Here's a set of numbers. It's 50.
Yes.
Yeah.
So I'm just out of luck on that.
It took me 20 minutes to get past the whole shoot run.
I thought the first one,
I went back.
If there was,
Yeah, you can start one. And that's all the way on to where, and then I saw it. I knew it wasn't something. Yeah, I know. Yeah, you in trouble?
and I was like, yeah, I remember there's a situation where keep a double taxation here.
Art turned to higher taxes when it comes to interest on investment. But this is active business. I knew you weren't here for the last 5. You need to know. When I first, for the first 5 minutes, I was like,